With the recent downturn in the market, I have a couple questions regarding capital losses and tax loss harvesting. First, I understand that capital losses offset capital gains of the same calendar year and that you can carry $3,000 a year forward to offset ordinary income. Can you also use losses to offset capital gains in future years? For example, say I have $100,000 in capital losses at the end of 2022. It would take over 30 years to realize the full ordinary income benefit at $3,000 a year. Instead, could I use this loss to offset capital gains 5 years later? Say I realize $50,000 of capital gains in 2027. Could I offset this with my 2022 capital losses? And if so, do these same rules apply to crypto investing as well? Going a bit further down the rabbit hole, would you consider a capital loss an asset? Could a large capital loss be considered a potential vehicle for asset protection? And finally, if one accumulates a large amount of capital loss and doesn't have a significant capital gain to offset, how is this managed with estate planning? Thanks for your help.
All right, great questions. Tax loss harvesting. Let's start with the basics, okay? First of all, a tax loss is never a good thing, okay? You don't want to lose money. This is a bad thing to lose money. You shouldn't look forward to tax loss harvesting, right? Some people are entirely too anxious and excited to get tax losses so they can lower their taxes. Remember, the goal here is to have the most amount of money after paying taxes, not to pay the least amount of money in taxes. What tax loss harvesting is making lemonade out of lemons. It's letting Uncle Sam share in your pain. That's what tax loss harvesting is. The idea behind it is you are selling an asset that has a loss in a taxable account. You don't do this in 401ks. You don't do this in IRAs. You don't do this in 529s or HSAs. Only your taxable account. You sell something, okay? And then when you do that, you are realizing a loss. You've lost money. You're recognizing to the IRS, hey, I lost a bunch of money on this investment. And when you do that, the IRS says, okay, you can use $3,000 per year of that loss against your ordinary income. And you can use an unlimited amount of that loss against your capital gains. And so that's basically what a tax loss is. And people go, well, that's a cool thing. I can lower my taxes with it. And they started getting creative with it, going, well, how can I grab that tax loss without selling low? Without, buying high and selling low, which is what you don't want to do as an investor. So what they do, they came up with tax loss harvesting, where you get the loss, but you're not selling low. And the way you do that is you exchange from one investment to another. You're selling something with a loss and you're buying something very similar to it, but not, in the words of the IRS, substantially identical. And then you get to claim the loss and you haven't changed your asset allocation. So you're basically invested the same way you were before, but now you have the loss you can use on your taxes. That's what tax loss harvesting is and why you might want to do it. So let me go through the specific questions here that this listener had. One, there was a little bit of confusion about carrying it forward, right? He said carrying $3,000 forward. That's not the way it works. You carry them all forward. If you don't use them that year, you carry them forward indefinitely. Okay, so that's not an issue. What the $3,000 is that's how much you can use against your ordinary income each year. Then he asked lots of really interesting questions. One's about crypto. Crypto, there's a loophole here for crypto. Normally, when you are tax loss harvesting stocks or mutual funds or bonds or whatever, you cannot buy back what you just sold for 30 days. If you do, that's called a wash sale and your loss is disallowed. It's not like the end of the world, right? You basically just have your basis carried over to whatever the new thing you bought was. But you don't get to use the loss. So in general, you try to avoid that. And that counts for a period 30 days after as well as 30 days before. You can't buy the new thing and then sell the old thing the next day. That's, they're on to you there. It's got to be a 30 days apart between those two events. That doesn't mean you can't sell something you just bought. You just got to sell all of it, right? For example, if you bought a bunch of total stock market shares last week and now you have a loss, you don't have to wait 30 days as long as you're selling them all. If you sell all your total stock market and exchange it for, S&P 500 index fund or whatever, Those two funds have a correlation of 0.99. They're going to perform essentially the same, but you book that loss, you're fine. But what you can't do is, uh, own a whole bunch of total stock market and only sell part of it, and then buy some and then sell some more. Right? They're on to you there. So you got to be a little bit careful with the wash sale rule. That burns a lot of people. The other thing that burns a lot of people, quite frankly, is what's called the qualified dividend rule. And a lot of your investments pay out dividends, and they're qualified dividends, meaning they're qualified with the IRS for a lower tax rate. And one of the rules in order for those to be qualified is that you have to own the investment for at least 60 days around the time of the dividend. So if the dividend's paid out on June 25th and you bought it on May 30th and you sold it on July 4th, that's not 60 days. That dividend becomes unqualified and you pay taxes on it at your ordinary income tax rates, not the lower qualified dividend tax rates. So this burns people when they're like frenetically tax loss harvesting, when they're tax loss harvesting every 2 days all month. And then they realize that they've given up more tax benefits by not getting the qualified dividend rates than they gain from the tax losses from tax loss harvesting. So quite frankly, you probably ought to sit on your thumbs a little more often and only tax loss harvest every 2 or 3 months, even in a dropping market. So don't get too carried away with it, or you may end up doing more harm than good. A couple other interesting questions there, I thought, that I don't think I've had anybody ask me before, was whether there's some sort of asset protection benefit from having a whole bunch of tax losses. And I can't think of one. This isn't like having a big
Yeah.
mortgage on a property where you've kind of equity stripped the equity out of the property. It's just a loss sitting there waiting for you to be able to use. But I wouldn't think of it as some sort of an asset that you could use for asset protection. It might help lower your future taxes. That's not going to protect from your creditors. Also, these all go away when you die. So you don't pass these on to your heirs. The good news is your heirs get a step up in basis when you die, but they don't get to carry forward your tax losses. So as you can tell, the first 3,000 per year are really valuable. Some amount above and beyond that is pretty valuable. And at a certain point, it really doesn't help you at all. There's a limit to how often, to how useful tax loss harvesting can be. But I understand
There's
you're going to be doing your first tax loss harvesting here coming up, Thisha.
well, I'm trying to decide, honestly. I've been binging on all your articles and Leaf Physician on Fire's articles about this because, honestly, well, you can't do it unless you have a brokerage account. And Josh and I just recently, started investing in the brokerage outside of the retirement accounts. And now we can, actually capture some of these losses. But my whole setup's been automation, and it seems that, I would have to change a few things. And I'm really excited that you are going over all of the details, because I feel like a lot of us do this where we just invest a set amount every month and it does it automatically, and I reinvest the dividends. So I think I would need to kind of look at all of that and make sure that I sell the ones that I just bought automatically, turn off the automation, and then also turn off the reinvestment of dividends and try and do that manually. Right.
Yeah, this is a big problem people have. I get this question by email all the time. They're like, I set it all up automatically, like I'm supposed to, right? Automatic investing and tax loss harvesting do not play well together. They just don't. It doesn't
Right.
work well. It's great to reinvest your dividends. It does create a lot of tax losses, tax lots to keep track of when you do that. So I'm not really a fan of doing it in your taxable account. And it's great to automatically invest every week or every time you get paid or whatever. You get that money in the market. It's working right away. You end up, getting the benefits of this periodic investing. And you end up doing really well in the long run. It's really a great strategy. It just doesn't play well with tax loss harvesting. So what I end up doing is I
Right.
take all the money I made that month, whatever it is, whether it's from dividends or whether it's from real estate rents, whether it's from my clinical practice, whether it's from WCI, whatever. And I look at it once a month and I invest it manually. I don't actually do any sort of automated investing. And, early in the year, it's going into 401ks and backdoor Roths and HSAs and the kids' UTMAs and 529s and that sort of stuff. Later in the year, it tends to all go into taxable. But I've essentially given up the benefits of automating everything in order to have a little more control over my taxes. Whether that's right or wrong is hard to say. There are people out there that just don't feel like tax loss harvesting is worth the effort. I mean, if you think about it, if you're only getting the $3,000 a year, that's only about $1,000 off your taxes for most docs. It's not a huge amount. And, and the truth is for lots of people, if they end up selling those shares eventually, they're only delaying the payment of the taxes on their long-term gains, which is there's a benefit there, but it's not, a huge benefit unless you're somehow flushing the capital gains out of your portfolio like I do with charitable giving. Then
Right.
you're just kind of delaying when you pay those taxes. So there's a pretty good argument to be made not to tax loss harvest at all. But I think it's worthwhile. I combine it with charitable
Mhm.
giving, and it becomes very powerful for us.
That's awesome. And I think a little bit also has to go with, your self-awareness of how well you're going to do if you do turn off the automation, especially in this kind of a down market where if the investment becomes optional every month, then are you going to stop investing? And,
Right.
because you
Exactly.
really,
I
so you
mean,
really
it's
need to know your behavior.
yeah, it's the classic behavior versus math thing, right? I mean, mathematically, you can
Right.
make a pretty good case for tax loss harvesting. Behaviorally, automating things is really powerful. That helps a lot of people to become millionaires and just putting things on automatic autopilot and going about their lives. I mean, how much time do you want to spend on your finances? You got to ask yourself that when you start looking at things like tax loss harvesting, like so much, like all the real estate investing we talk about here at the White Coat Investor. It's optional. You don't have to do it. You can become a financially independent multimillionaire without investing in real estate at all. And tax loss harvesting is kind of the same way. It's optional. You don't have to do it. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.